Is there really a secret cheat code the wealthy use to build tax-free fortunes? Welcome to Dollar Playbook. I am Taylor Reed. Today, we're diving into a massive trend you have probably seen all over your feeds: infinite banking. This explainer is designed to cut through the hype and demystify this viral wealth-building concept, one that promises to completely change how you manage your money. We are going to look at the facts calmly, clearly, and without the sales pitch.
Let me ask you this. Have you been scrolling through social media recently and stumbled across one of those viral Become Your Own Banker videos? You know the ones. It's usually a guy in a really sharp suit standing in front of a whiteboard, passionately promising you a financial cheat code using life insurance.
Their whole pitch usually boils down to one incredibly powerful line: the wealthy have been using life insurance to build tax-free fortunes for generations. And hey, I want to acknowledge right up front, that sounds absolutely amazing. I mean, to anyone out there working hard, trying to accelerate their wealth, the idea of unlocking some hidden secret used by the ultra-rich, it is literally the ultimate hook.
Section 1. The Setup. Ethan's Story.
So, to figure out if this strategy is actually a brilliant move or just a really costly trap, we're going to run the objective math on a real-life case study. Let's meet Ethan. Ethan is 30 years old and he makes $70,000 a year. He is doing all the right things, right? He's contributing to a 401k, putting some cash into savings, and he is actively looking for that next step to build real, lasting wealth. After watching a few too many of those viral pitches, Ethan is seriously considering committing $750 every single month to an infinite banking whole life insurance policy. For a regular guy like Ethan, that's a massive commitment. That is 13% of his gross pay, $9,000 a year, going straight into this strategy.
Section 2. Looking under the hood. Before Ethan even thinks about signing that paperwork, we really need to look at exactly where his money is going. When you pay that monthly premium, it doesn't just sit nicely in a savings account. It gets divided up. A portion pays for the actual death benefit, and another chunk goes to the insurance company's overhead. But here is the absolute shocker. Are you ready for this? A staggering 70 to 110% of your first-year premium goes straight to the insurance agent's commission. Honestly, on some of these policies, the agent selling it to you makes more money from your first year than you actually put into the cash value. This is exactly why your early cash balance barely even moves.
Now, the folks selling infinite banking, they know about this slow start. So they designed the policy with something called paid-up additions, or PUAs. Basically, this is just extra money that you dump into the policy on top of your base premium, just to accelerate that early cash value growth. But here's the catch. Even with a perfectly optimized policy using PUAs and earning insurance dividends of roughly 5.75 to 6.60%, those early years, they are still a remarkably slow grind.
Section 3. Running Ethan's Numbers.
Let's actually track his $9,000 annual contribution over a realistic 30-year time frame. Walk with me through this timeline. After year 1, Ethan has paid in $9,000, but his actual cash value is only sitting somewhere between $6,300 and $7,200. Yep, he is down 20 to 30% right out of the gate. By year 3, he's still totally underwater. It isn't actually until year 5 to year 7 that the policy typically breaks even. By year 10, he finally has between $85,000 and $100,000. From there, the compounding finally kicks in, and that produces a respectable $400,000 to $500,000 by year 30.
Section 4. The Simpler Alternative. Look, $500,000 is absolutely real money, but we really have to ask the most important question here. What if Ethan had done something much, much simpler with his $750 a month? Let's outline the alternative path. Instead of buying whole life insurance, Ethan secures his family with a basic 20-year term life policy for about $30 a month. That gives him the exact same $500,000 in protection. Then, he takes the remaining $720 a month and just invests it in a low-cost S&P 500 index fund. For our math, we'll use a conservative 8% annual return, which is a very fair, real-world estimate.
And this right here perfectly illustrates the reality of these two choices. Just look at the strategy comparison. By year 10, the simple term life and index fund strategy is comfortably pulling ahead. By year 20, that gap widens significantly. But take a look at year 30. The whole life cash value is sitting at $400,000 to $500,000. The term life and index fund combination, roughly $1.05 million to $1.1 million. That is a staggering difference. We're talking more than double the money. Even after you factor in capital gains taxes on that index fund, Ethan still comes out hundreds of thousands of dollars ahead with the simpler method.
Section 5. Popping the illusion.
So the math is incredibly clear, yet those viral pitches just keep on coming, don't they? It's time to talk about the hidden traps that those short videos conveniently leave out. The massive hook of infinite banking is this idea that you can become your own banker and borrow from yourself. But honestly, that's a bit of a misdirection. What you're actually doing is taking out policy loans. This means you are borrowing money from the insurance company, and they are using your cash value as collateral. When you need money for, say, a new car or a sudden emergency, you aren't actually withdrawing your own cash. You are taking a loan against it.
And the absolutely crucial point here is that this money is not free. The insurance company charges you real interest on these policy loans, typically right around 5 to 6%. So think about it. If your cash value is earning a net dividend of 5 to 6% and you are paying 5 to 6% in loan interest to borrow it, well, those two forces basically cancel each other out. You are simply getting access to your own money, but at a cost.
Then there's the intense risk of the commitment itself. The whole strategy requires you to pay hundreds of dollars every single month for decades, without failing. But what's the reality? Industry data shows that the average whole-life policyholder lets their policy lapse around year 7 or 8. On a $70,000 salary, just one financial shock, like a medical emergency or an unexpected job loss, means you might not be able to afford that hefty premium. And if that happens, you have to surrender the policy for a loss, right before it even breaks even, and the insurance company keeps the rest. Ouch!
Section 6. Who is this actually for?
Now, I want to be perfectly clear about something. Infinite banking is not a scam. Whole life insurance is literally one of the oldest, most stable financial instruments in existence. The problem isn't the product itself, it's that it's being heavily marketed to the exact wrong demographic. So who is this actually for? The real target audience is high earners, folks making $250,000 or more every year. It is for people who have already completely maxed out their 401k and Roth IRA limits, and they just desperately need a tax-efficient place to park their extra wealth. It's for high net worth individuals who need estate tax protection for estates over $10 million, or maybe business owners looking for strategic liquidity. For the truly wealthy, these policies are a brilliant tool, but they are a wealthy person's finishing move. They are absolutely not an everyday person's foundational step.
Section 7. Your Wealth Playbook. If you're an everyday earner like Ethan and you're just looking to build a stable, wealthy life, let's pivot to some practical advice you can actually use. Here is the simple wealth foundation you need. Step 1. Buy a 20-year term life insurance policy for basic, affordable protection for your family. Step 2. Contribute to your 401k just enough to get the full employer match. I mean, that's a 100% instant return. It's literally free money. Step 3. Open and max out a Roth IRA for completely tax-free growth. And Step 4, invest whatever money you have left over into a low-cost S&P 500 index fund. These 4 steps are reliable, they're boring in the best way possible, and they allow compounding to do all the heavy lifting for you without locking you into some extensive 30-year trap.
As we wrap up, I want to leave you with this final, vital thought to reflect on. Are you making financial decisions that match your actual reality? Or are you just buying into someone else's sales pitch? Remember, the math never lies. Thank you so much for spending your time with me today. I am Taylor Reed, and if you found this explainer helpful in cutting through all the online noise, please gently hit that like button, share this with a friend who needs to hear it, and subscribe to Dollar Playbook for more practical, trustworthy financial lessons. Catch you next time.